Welcome back to the channel. It's your favorite value investor, Racky Ryan. Today I have to talk to you about my Intel stock update. Look guys, I know that I've made like 3 or 4 videos on Intel in the past, but I just reran the stock model and it is even higher than what it was in the past. You don't want to miss this. You absolutely have to see what my model is valuing Intel at. I'm not only saying this, I'm going to be buying even more shares. Intel is one of my largest positions, and after today, it's going to be my largest position. I have the highest conviction on this stock as a value investment because it is so undervalued. Stick around, you're going to see what I mean by this. I'm going to break it down for you, and you will see why I think Intel is so undervalued. Keep in mind though that I am not a financial advisor. My views are my opinion, and this is for entertainment and educational purposes only. My first video, which was on Intel stock, was about 2 months ago, okay? And at the time, I only had 2019 financials. I ran my model, and the stock value that I got was $60 per share. In that video, it was trading at $51 per share. I mentioned at that time, we really just need to get some good news, and maybe Wall Street will stop depressing the stock price and thinking that Intel's dead, Intel's dead. Well, we got good news. We got a new CEO, Pat Gelsinger. Pat Gelsinger was the original chip maker at Intel. Recently, Intel just announced that they're going to be investing $20 billion into making more chips in America. Why? Because there's a huge shortage of chips worldwide. What happens when there's a huge demand in a product? The product goes up in value, or the companies that are selling the product do well. Intel is the largest producer of semiconductors in the world, okay? Keep that in mind. Next, Intel stock is still making money. Ooh, Intel's dying. No, Intel is not dying. Sure, AMD is having a good run up, but AMD and Intel always do this. They go back and forth, back and forth, back and forth. If Intel is dying, then let's take a look at the financials and tell me, why are they still making money? Why is free cash flow per share growing at such a high pace? Please, let's break this down. If you think that I'm wrong, comment below. I would love to hear your perspective. If you think I'm right, comment below. I would love to hear your perspective. But I am telling you, Intel is undervalued, and I'm going to put my money where my mouth is at. Okay? Here we go. This right here is the financials for Morningstar. Type in Intel, you go to key ratios, full key ratios data, and all I do right here is literally screenshot it like that, okay? And then I bring that screenshot and I put it right here. And that's what you're looking at. Now, so I have made a lot of videos on Intel in the past. I started when the stock was trading at $51 per share. When it was trading at $51 per share, we had 2019 numbers, okay? And now we have 2020 numbers. So I'm going to rerun my model to show you what my model has come up with. As you can see here, I have already reran the model, but I'm going to run it with you guys in order to show you how I derived my new updated price target. Now, I am a huge Intel stock bull because I am a value investor. What I do is always go hunting for value. I like to look at the companies that are going to do well in the future, and there's a lot of people saying, oh, this company is not going to do well, Intel is dying, etc., etc. They're going to look at Intel, and it creates this groupthink. So there is currently this groupthink that Intel is dying. But when you take a look at the revenues were stalling out, but they were growing from 2011 to 2015, and more recently, they've been growing massively. And what do we love in this channel? What do we love? What does Racky Ryan love? What are you going to end up loving as a part of this community? You're going to love free cash flow per share. So we've seen a steady rise in the free cash flow per share over the years and a gigantic jump in the free cash flow per share. So why is that? Because Intel is buying back their own shares. They think that their company is undervalued. When a company buys back their own shares, they generally think, hey, the market is wrong. Our company is valuable, and the use of our cash, our extra money, our operating cash flow is going to be used in order to buy back shares, because that's going to create more value for our shareholders. And so when you have less shares, the free cash flow per share is going to increase. So when the free cash flow per share increases, that means that us as investors are going to reap the benefits. That means that they can do more things such as raise dividends, or they can invest into the business such they have with their capital expenditure of their $20 billion plants that they're building in Arizona. So again, Intel is doing everything correctly. They're primed for the future because everything is going to become digital. I'm telling you right now that Intel is undervalued, Intel is undervalued, and Intel is undervalued. I'm going to continue to make videos on this until you understand why I'm so bullish on this stock. So let's run my model again to see my updated price target. So whenever you run my model, the most important metric, if you've seen in my videos in the past, is the free cash flow per share. So the free cash flow per share for 2020 was 4.73. So we're going to enter that in right here. And then you go back 5 years to get your free cash flow per share, to get your compound annual growth rate over the past 5 years. That number is 2.47. So I enter that number, and that gives me a compound annual growth rate of 13.88%. If you're not aware of what compound annual growth rate is, there's a video above that you can watch after this video in order to understand. So what I like to do when I run my model, because we're going to run 3 assumptions. So what I mean by that is we're going to use these numbers because they do not change, and we're going to run it 3 times. We're going to project out the future growth rate. So the first assumption, I always use the past historical compound annual growth rate, okay? And that's 13.88%. Next, we're going to assume a 10% discount rate. We're going to use a discount rate because we have to discount our stock against the opportunity cost of investing elsewhere. You could buy Intel stock, or you could just go ahead and buy the S&P 500. In the end, one is going to do better than the other, but you have to assume that you could go ahead and just buy the S&P 500. I know this may seem confusing, but over time, as you watch more and more of my videos, and I'm going to do a video on this just explaining this in general, you'll understand what I'm talking about. So I'm going to use a 10% discount rate. You have to assume that the economy is going to continue to grow at a certain rate. So historically, inflation's been about 3%, so we're going to use a 3% GDP rate. This gives you an intrinsic value of $99 per share. My model is saying right now that based on these numbers, Intel is worth $99 per share. Now let's take a look at what Intel's trading at. Intel is trading at $65 per share. So 65.62, and that gives you 51% upside. 51%. So in theory, this stock is technically, according to my model, 51% undervalued. Okay, all right, so Racky, maybe Intel's not going to grow in the future at 13%. I think it will, because the future is moving towards everything that uses semiconductors. There's a semiconductor shortage, but let's just go with a bearish case. Okay, fine. I'll go really bearish. Let's cut this number in half to 7%. 10% discount rate because you're going to keep it the same as your previous assumption, 3% GDP growth rate. The intrinsic value, if you cut the previous 5 years compound annual growth rate in half, is $74 per share. Currently trading at $65.62. That's 12% upside. Intrinsic value is the value of the stock today. This is the model that Warren Buffett uses, that was taught to him by Benjamin Graham. You can learn this from the book that's in my description below. And quite frankly, that is an extremely bearish case, but the stock is still undervalued. Now, we can run it again. We can run it again. We can go with 10% because everyone's bearish on Intel for some reason. So let's say we go with 10%. Stock is still undervalued. This gives it a intrinsic value of $84 per share. And for fair measure, since the whole world thinks Intel is dying, which I don't think it is, this reminds me of Microsoft back in 2012, 2013. This reminds me of Apple stock in 2016, 2017, and look at how those stocks have performed. And I'm going to pull that up so we can take a look at that after this model. So my new updated price target for Intel is $84 per share. But I just want you to see something. Let's just say Intel does do well with these investments into the business by building plants in Arizona. Let's just say that actually works out. And let's say we go with a 15% future growth rate. The stock is worth $103 per share. And that is a 58% upside. We can go with 9%. That gives you 80. We can go with 5%. That still is higher than where we're at. So if I cut this percentage in half by like 70% future growth rate, the stock is still undervalued. Why is that? Well, let's take a deeper dive into Intel stock. Intel stock is trading at a 13 price to earnings. 13. That is so low for a tech company that's growing revenues. Also, they pay a 2.13% dividend. So not only is this a tech company that's growing its revenues, it's demonstrably undervalued, it also pays a dividend. So let's pull up how many shares I have. I'm not just saying this, my money is where my mouth is at. So you can see here that look at INTC. I have INTC. I have 281 shares. 281 shares of Intel. I have an $18,000 position in Intel. I'm not just saying that I think this company is undervalued. I have my money where my mouth is at. In fact, I'm gonna buy more shares of Intel right now. I'm gonna cut the screen record right now because this shows my personal information, and so that would just be stupid to give out my personal information and then some hacker or someone like releases that. I'm not doing that. So I'll show you a screenshot once I'm finished. 100 more shares is $6,563. That's quite a position. That's quite a buy. Wow. So yeah, I'm gonna buy $6,000 worth of Intel stock right now because I believe the stock is demonstrably undervalued. And then you're going to see this once I do a screenshot at the end. So in this account, I now have $25,000 in Intel stock. Meanwhile, the whole world is saying Intel is dying, Intel is dying, Intel is dying. I totally disagree. And only time will tell, right? I could be wrong. Again, these are just my opinions, but I'm going to drill it into your head and we'll see it over the long term whether I'm correct. I'm not looking to pressure you into buying, but I'm showing you my process of how I value a stock using the discounted cash flow model. I look and I take an independent, non-biased, objective thought process. I don't care what analysts have to say. Analysts are wrong all the time. I run my own independent research and then I make my buys. This is what I do for all of my stocks. I originally valued Intel stock when I had the 2019 numbers and my model said that it was worth $60 per share. Now I have the 2020 numbers and now it is saying that the stock is worth $84 per share with 28% upside. And what that is called is a margin of safety. Benjamin Graham taught Warren Buffett to have a margin of safety. If you buy a stock and its intrinsic value is demonstrably higher than what it's currently trading at, so a 20%, 28% upside, then you should buy as much stock as possible. And that's what Warren talks about. Whenever they find a stock that they think is undervalued, they don't just buy a little bit, they try to buy as much as possible. So now I am continually buying Intel and I'm putting my money where my mouth is at. So now we're gonna take a look at the balance sheet of Intel. So again, this is my favorite website, Morningstar. And some things that are important to look at is the total current assets versus the total current liabilities. So I've pulled up the balance sheet on Intel. This is something that I like to look at. The total current assets is 35 billion. The total assets is 113 billion. Their total current liabilities is 20 billion. So they have a lot more assets than they do liabilities for current, and their total liabilities is 47 billion. So this is a company that doesn't have a bunch of debt and they have a bunch of assets. So that's a check mark for a value investor. Again, I mentioned, now I have it pulled up. Again, I mentioned shares. When you're a value investor, one of the most important metrics to look at is obviously the free cash flow per share, but also is the amount of shares. This company is buying back their shares. And they are buying back their shares, which means there's more money per share for you as a shareholder. Because when you're a shareholder, you're an owner of the company. So they have been buying back their shares like crazy. This has gone down 1,400 over, this has gone down basically 26% over the past 10 years. And they're continually buying back shares of their company because they're the ones that work in the business. They know how their company's doing. And this shows to me that they think that their stock is undervalued compared to the market. And I know I mentioned earlier how this reminded me of Apple back in 2016, 2017. So you can see, yeah, they stalled, they had some revenue stalls in this area, but since then, their revenue has been growing very rapidly. I mean, to grow from 71 billion to 77 billion, is that a dying company? That's not a dying company. So now I'm going to pull up Apple on Morningstar to show you what I'm talking about. I'm going to show you how I think that this is a very similar situation. So Apple in 2015, 2016, look at these numbers. They grew revenue from 2014 to 2015, and then they stalled and they went negative on their revenue from 2015 to 2016, and then they went to 229. And at the time, was people saying Apple's dead? No, but they were trading at a 10 price to earnings. 10. And recently, Intel has been trading at a 10 price to earnings, but the stock has been going up in value because they got a new CEO in Pat Gelsinger, and people are starting to see that this stock is undervalued. So I think that this is a very similar story to Apple. And so Apple has then grown their revenue and they're doing well. And their free cash flow per share was kind of doing similar situation as Intel, and then it had a massive jump. So I think that in the future we're going to be seeing Intel having a similar situation as Apple. And also the parallels between Apple and Intel is also more than just the revenue and free cash flow per share. Pat Gelsinger was the original chip maker at Intel, and he left to become the CEO at VMware. And now Apple, you remember that Steve Jobs story. Steve Jobs was kicked out of Apple, but then they brought him back. So it's a very similar type story where they bring back the OG founder or the OG chip maker, and they bring him back to relevance and glory. So I think that Apple from 2015, 2016, 2017 is going to be very similar to what's going on with Intel right now. And I just put my money where my mouth's at by buying 100 shares of Intel. So if you like this video today, make sure to hit the like button as well as subscribe. Please leave a comment below on what your thoughts are. If you are a bear on Intel, please tell me. If you are a bull on Intel, please tell me. I am open to discussion. I want to know. These are my thoughts. These are just my opinions. At the end of the day, we're all in this together. We're on the journey and we're on the road to racks.